Clearly a big winner this morning, but we've got 3 new listings as well. So let's check in on how those have, panned out in trade. You've got a Lohia Corp, you've got MIM, Extranet. So these are all the listings for the day. I'm just looking at the, prospects for Lohia Corp as well. It was a price band of 425. 1,100 crore, 2 crore rupee issue. That was the total IPO size as well, given that there are manufacturers of machinery and equipment for technical textiles with a very strong focus on solutions for producing very niche woven fabric and sacks as well. Those are the listings for the day. Indo-MIM, of course, has had a stupendous start there. 45% of an uptake or premium is what it started off the day with. Not such a great start for Extranet Tech, which is down about 1.5%. So it started off at a discount to its issue price. And Lohia starts off with a premium of about 8.5%. But yes, the big one, of course, is today Indo-MIM. But let me now welcome on board Kamlesh Gandhi, the CMD at Mass Financial Services, and figure out what their earnings performance has been like. Kamlesh, hi, morning. Great to have you today on ET Now. Kamlesh, your funding costs, from what I look at it, have fallen much faster than asset yields have improved. Should investors expect this spread benefit to translate into higher NIMs over the next few quarters?
Good morning. I wish so, because the cycle of lower interest rate had just started before we face this macro headwinds of US-Iran war and all those stuff leading to higher inflation probably. So if the rates are held on as expected by RBI and the liquidity flows in as expected, I think we should expect these rates to continue and hence higher NIMs.
Mr. Gandhi, 5.5% sequential this quarter. That looks strong at the outset itself. Can that sustain? And if that does, you could well do the higher end of that guided band of yours, 20 to 25%. You'll probably do closer to 25 for full year.
We are very optimistic that we should be doing anywhere around, say, 22 to 23%. Can't predict it, but we are anticipating a growth of 22 to 23% in AUM. We will try hard to reach to the higher band of 25%. But having said that, if you see the current quarter's performance, it has been in high quality growth with close to 21.5% growth in AUM and 27% growth in profitability on a consolidated basis, reflects the operational efficiencies that are set in now.
Right. Mr. Gandhi, nearly 80% of your AUM growth continues to come in from the MSME sector, right? Given the increasing competitive intensity in secure MSME lending, do you see this mix change or evolve over the next 2 to 3 years, particularly with faster growth in two-wheelers and housing finance?
See, as far as the opportunity in MSME is concerned, that is huge. We have a huge opportunity in MSME financing, and if you see our presentation, we have given one report published by SIDBI that there is a huge gap in serving this segment. But having said that, we believe that we should have a diversified asset as we increase our balance sheet size, and hence we will be focusing on wheels portfolio also. So in that context, the MSME contribution might marginally decrease. But however, will remain predominantly an MSME financer.
And wheels, that portfolio is growing, I can see, and it's growing well. But off a low base, can you grow faster?
We expect so. With going forward, stabilizing our distribution channels, and as we get confidence on the risk-adjusted return that it can generate, it on a lower base, it can grow at a faster pace. That is what our expectation is there in medium to long term.
Mr. Gandhi, that you're growing slower because you want to test the portfolio a little bit longer before you start growing fast, because 2,000 crore odd in terms of the portfolio size, and you've done what I believe 15 odd % in terms of the growth number, 16% maybe in terms of the growth number. That's a far cry from your overall blended of 20% plus.
So that is what I was sharing with you. that once we get the confidence on our distribution channels, and once it proves its metal on the litmus test of risk-adjusted returns, the same will grow at a faster pace. But as you know that we are never in a hurry to grow a portfolio. We take our own time to grow the portfolio, but we prioritize risk and profitability.
And what are the early signs showing you with regard to the wheel segment? Is it showing you that you'll likely be comfortable with regard to growing this segment at a faster clip? And if so, in which quarter does the inflection point come?
No, we do see positive signs there, and hence I shared earlier that that portfolio will start taking some share from our MSME financing, making us a real diversified on the asset base. And I think as far as two-wheeler is concerned, Q3 should be Q2 and Q3 combined should give a good growth, being the festival season. And as far as commercial vehicle is concerned, we'll take still 1 or 2 more quarters to grow it faster.
The cost of borrowing number has shrunk very sharply, right? 14 bips QOQ is really no mean feat. I mean, even YOY, the number is impressive, but QOQ especially. Could you give us some color on what exactly has transpired?
So if you see, I'll take that right up to the COVID era, that post-COVID, the borrowing cost had increased substantially. And if you see our historical borrowing rates, and we have shared the data right from the 23, financial year 23 quarters, that we were below 9% in our borrowing cost. So I think with reduction in MCLR, that being transmitted over a period of time, and our efforts to find out lenders who can give it as a better rate, it's a combination of all the efforts that yielded these results. And if this continues and if the repo rates hold on and the liquidity is sufficient enough in the system, I think we'll be in a position to maintain these rates.
Mr. Gandhi, the street is curious to know how is it that you're going to be leveraging tech now to try and evolve and garner more business going forward?
So we always give a detailed presentation on how we are utilizing tech, and that is reflecting on our stabilization of our operational cost also. So we have a 100-member team on as far as the tech is concerned. We have a build and operate model where we have the complete loan origination system and loan management system on board. We have started using BRE extensively by using the data what we have with us over all these years, and accompanied by AI. So there will be a very progressive movement as far as the tech utilization is concerned that will not only kick in efficiencies, but I think that will also help us give us better results on our credit assessments, and hence the quality of the assets also going forward. So use of tech is an integral part and is an area of focus as far as mass is concerned.
Okay, Mr. Gandhi, thank you so much as always for coming in, speaking to us, and good luck for the quarters ahead.
Thank you so much. Nice talking to you.
Thank you. Very good speaking to you too, sir. What we'll do is to in a very short break, come back, speak more. Lots of corporate conversations today, only on ET Now. You want to stay tuned here. Welcome back, and we're joined by Sajid at this point in time to look at how the F&O trends are shaping up in the market. Over to you, Sajid.
Thanks, Harsh, for that. The market absolutely flat at this point in time. Nifty, it's just hovering at yesterday's close, but we're seeing some shorts getting built at this point in time, and that's what is putting some kind of pressure on the Nifty and preventing it to go above the 24,250 mark there. But Nifty Bank again is down over 0.5% in today's trade. Shorts getting added there in Nifty Bank futures. Premium at 556 points to the spot at this point. Look at the constituents of Nifty Bank. You see short build up across the board happening, whether it's a private sector bank or the public sector bank. You're seeing shorts getting added across the board for HDFC, ICICI, SBI, the three big banks which are seeing some kind of pressure in today's trade there. Among the put and call writing, you are seeing some kind of support which is coming at 24,000 and 24,200 and that's holding off as of now. Look at the distribution side. You still have 24 24,200 holding up, but 24,300 is something which is where we see the call open interest positions much higher. So you have a resistance coming in at 24,300 followed by the 24,500 mark there. But future gainers include stocks like Hero Motor, where we are seeing the stock up nearly 3.7%, persistently seeing some long build up coming in, stock up 3.6%, and Oil India is seeing some long build up with stock up, futures up nearly 2.8% in today's trade. Among the losers, you have KPIT Tech down 7% after muted commentary which is coming in after the earnings. Vari Energy is seeing some margin pressure, so the stock is down 6%. Inox Wind again seeing nearly 3.5% fall in today's trade. Among the open interest gainers, you have Vari, where we have seen 11% jump in open interest. KPIT is seeing a 7% jump in open interest, and Dabur is seeing nearly 6.5% jump in open interest. All seeing some short build up coming in there. In the losers pack, Wipro is seeing a short covering, Torrent Pharma is seeing a short covering, and Avenue is seeing a short covering in today's trade. But the most active stock options today is Infi 1200 August call, stock hovering around 1185 odd, 2.8 lakh contracts getting added there, and the premium up nearly 10.75 to 31. So that's one very active call in today's trade. Among the put, you have KPIT's Tech 600 August put, where some unwind is being seen, 65,000 contracts getting unwounded there at, and the stock hovering around 590.3 at this point in time in the futures, but the premium up sharply 17.6 to 28.7. So the market's at flat in today's trade. Banks are the ones which are putting pressure on the index.
Absolutely flat for the index, but like Sajid just flagged off, a lot of individual stock-specific activity already, under that underlying flatness of the market. Lots really is happening within that. But let's focus on another set of earnings, and we've got the management of Redington joining in on the show right now. V.S. Hariharan, the MD and Group CEO, joins in to chat about how their earnings were and what's it looking like going forward as well. Mr. Hariharan, great to have you today on ET Now. Thank you so much for your time. Your top line has grown over 34.5% against the estimate of 29,700 thereabouts that the street was actually working with. That's a very, very sharp beat. Congratulations, firstly. But tell me, how much of this is durable? And more importantly, annuity-like demand versus a one-off pull going forward, especially with growth strongest in markets like India, South Asia, and Singapore for you.
All right. Thank you so much, Aisha, for having me on the show. Yes, we had a fantastic quarter, the highest revenue ever, the highest profit ever. Normally, Q1 is a little bit of a low seasonality quarter for us. Like you said, 34% top line, 77% bottom line, 35,000 crores of revenue, 486 crores of profit. We are very proud of what has been achieved. So if you look at the engine of the growth drivers here, India did fantastic for us, clearly, over 60% growth. South Asia, as you mentioned in your message as well, we did well. Middle East Africa, which has actually been hurt by the West Asia crisis, grew 15% for us. And there were pockets of very decent growth, like Africa was a good growth. The GCC Levant regions was a good growth. We had muted growth or negative growth in UAE and Saudi because of the West Asia crisis and some of the demand softening there, but it is still better than we thought. So overall, geography was good. Now, if I look at business units to give you a perspective for what's going forward, all four business units we have, whether it's mobility, endpoint devices, the technology solution, server storage, and the software solutions, all grew strong double digit. And across the board, and India in particular, even faster. What is driving it? Clearly, we can see a demand spike for AI, GPUs in TSG and the data center business. We are seeing a good growth in software solutions, really driven a lot by us trying to gain share there. And on the endpoint side, the price increases due to the component shortage has helped us to get our ASPs, average selling price, and the higher revenues. And premium phone consumption continues to outpace the overall smartphone market, and we play into the premium phone market. I would say, as we look forward, clearly a lot of this is sustainable. The only area of concern for us, because of the price increases on PCs and smartphones, at some point we could see a consumer demand softening. We're already seeing unit growth is flat to single digit. Because of the price increase, we're getting some of the revenue increases. Now, how much can that sustain beyond the next few quarters? We'll just have to wait and see.
The other thing that I, observed also is that your EBITDA margins expanded about 2% from the earlier 1.5%. Having said that, your consolidated gross margins have actually seen a dip. Now, I understand that it's the ex-Arena margins, which is currently at play. But what I want to understand is how much of the reported margins is actually an improvement in the genuine operating leverage sense versus Arena drag sort of masking the operating leverage for you?
No. It is there is a genuine leverage. Very good question. But if you look at excluding Arena, there is a genuine leverage that we see. Our OPEX grew single digit this quarter when everything else has been double digit. And we are getting leverage because we are generating much higher revenues on the same OPEX base. But if you specifically look at the mix of businesses, because Software Solutions Group is growing faster than the rest of the business and delivers a 6% plus gross margin this quarter, that gives us a better boost as well. And on the PC side, the higher ASPs has delivered a slightly higher gross margin. So clearly there has been leverage. There has been some specific factors because of mix as well as the PC price increases. All of that has contributed to the margin. I would say we want to be able to sustain. That's our goal, to be able to sustain and improve. And on the gross margin side, clearly a lot of things at play right now, too many variables at play, but our intention is to continue to grow the gross margin and the EBITDA.
And how much of that gain will come from the SSG and how much of the gain will come from your traditional businesses? Because SSG was, I believe, sub 1% of your top line, FY26. So can you give us a sense as to how the revenue mix is shifting and how that is likely to impact your margins?
No, so it's not 1%. The SSG mix of the entire business is 17% top line. And the bottom line will be more than 17% because it delivers higher than average bottom line. And that will continue to grow, the SSG mix within the business as it grows faster than the rest of the mix. So that's clearly one bottom line contributor in terms of growth. But we have even on the our TSG business now is picking up momentum. So the run rate business on TSG, we are trying to grow the gross margins there. It is hyper competitive. And on the PC side, the higher price point that I mentioned will continue to give us some additional gross margin moments there. But clearly the key driver is going to be on the gross margin, and the EBIT driver is going to be software solutions and the professional services inside it, which is now 17% of the mix.
Understood. But you've also guided Arena losses to shrink in FY27, right, Mr. Hariharan? What I wanted to understand is how much of your group margin recovery story hinges on that premise? And should there be a delay, then what happens?
So we did guide that we'll get better, but what we are seeing after exiting from the Lira business in Turkey, the size of the business has shrunk, but the gross margin, there's a gross margin compression as well. So it is going to take a little longer. We'll have to do some restructuring there in the Arena business to get us to profitability levels. So we do see a few more quarters of work to get there. We are headed in the right direction. But what we see is our other constituents, whether it is India or Middle East Africa, are definitely delivering both revenue and profit growth better than we expected as well. So that should compensate. So if I look at the future outlook on profitability, not concerned. We will have to work the Arena problem in the next few quarters to solve that.
So you're seeing a delay beyond FY27, is it?
No, it is definitely, it will be solved. We have a strategic approach on Arena, and we will solve the problem within FY27. So we hope as we get into FY28, we are not carrying that problem of Arena. Yes.
Last off, Mr. Hariharan, trying to understand, you would obviously be carrying some inventory, and the kind of pricing that's playing out in the market means that the inventory that you carry has a better resale value. How much of that is proving to be a tailwind in the current margin number that you're clocking? Because I'm sure that there is some amount of tailwind that you're seeing there.
I would say definitely a small amount, but it's not significant. Why is it not significant? Because this only helps for the stock and sell business for endpoint solutions. Most of the sales we do on technology solutions is largely back-to-back. Software solutions is back-to-back. There's an end customer involved, pricing is decided, etc. And on the PCs, all back-to-back deals, and mobility is a high-velocity business. So only on the endpoint solutions, wherever we stock and as the prices go up, there is a little bit of a margin effect there because of the price changes. But I would not say it's significant.
Last off, Mr. Hariharan, just on the AI capex and data center capex cycle, which is at play, you're obviously benefiting from that. Your top line is benefiting from that. One, sustainable, and two, what if the global AI capex cycle were to reverse? Is there a risk there?
Yeah, there is so if I look at AI capex, there are two parts to this. One is the AI GPUs that we sell within the technology solutions. So the data center business was only accounted for about 700-800 crores this quarter. We do have a very healthy backlog, multiple times that for the next few quarters. So there's not a very big number baked in terms of what we are doing today, and we are delivering what we're delivering despite that. But clearly on the PC side, on the commercial PCs, there's a penetration of about 36% AI PCs. But as we go forward, all PCs are going to become AI PCs. That's going to be the new normal. And then the run rate servers we sell in technology solutions is also going to become AI GPUs are going to become run rate. So there is not a lot of AI capex built into us, our numbers today as such. So it can only get us an upside. I don't see a downside from an AI capex cycle perspective.
Thank you so much, Mr. Hariharan. This gives us good clarity on the numbers. Congratulations on a very strong set. Of course, the stock perked up 10% as a result of that. And thank you so much for the conversation.
Thank you so much. Thanks.
And turning out to be a subdued day for Indian equity markets after the kind of day that we saw yesterday, with Nifty continuing to hover near that 24,230 mark. But several individual stocks, especially from the mid-cap pack, are in focus today, and we'll put the spotlight on some of those in just a bit. First up, let's take you through all the top headlines that we're tracking at this hour. KPIT Technologies is under pressure today after a large block saw a global institute sell a stake in the company. The stock saw a rally yesterday after first quarter results reported better than expected dollar revenue. Management also indicated that the second quarter is likely to remain flattish following weak first quarter performance. The stock is down more than 7% in trade today.
Vari Energy has slipped after reporting a mixed set of first quarter numbers with revenues broadly in line, but margins and profitability have both missed street expectations due to weaker operating performance that the company seen in the quarter gone by. They have, however, maintained their FY27 EBITDA guidance, highlighting a strong 61,500 crore order book, continued ramp up in manufacturing capacity as well.
And Dabur India trades higher after delivering an in-line quarterly performance. Of course, the stock has flipped quite a bit, supported by healthy profit growth and margin expansion. However, India volume growth moderated sequentially from 6% earlier to 5% now, indicating some softness in underlying demand, which is why the stock is down 5% in trade as we speak.
Prestige Estates as well has declined after reporting a weak set of first quarter numbers. They've seen higher costs and lower realizations, both weighing on the company's overall profitability, even despite revenue growth seeing an uptick. They've also seen rising employee contract and finance costs, which have continued to pressure margins as well.
Meanwhile, Syngene International comes under pressure after lowering its FY27 revenue outlook, citing the loss of the Zoetis contract and expecting revenue to decline in the first half before business momentum improves in the second half of this year. The company has reiterated its investment plans in new capabilities and manufacturing infrastructure. The stock has recovered a tad bit, but despite that, down 7.5% as we speak.
And those are some of the top headlines that we've seen in today's trade. And among that list, Vari Energies, that company's reported its first quarter results, and revenues just come barely in line with the street's estimates. EBITDA has seen a complete miss. PAT as well has seen a complete miss, leading to an overall neutral to a more of a declined or a negative sort of first quarter numbers that the company's put out. If we take a look at the headline numbers, and revenues down about 6% on a quarter-on-quarter basis, and still up 79% year-on-year. And we have on board with us the management of the company here to break that down for us. Welcome to the show, Mr. Abhishek Parekh. He's the CFO of Vari Energy. It's very good to have you on the show today. Starting off, sir, your order book has reached around 61,500 crores. Can you tell us what is driving the strong demand and how confident are you on the execution here on?
This quarter, we have seen a defining moment when we see our order book going high at the all-time high level of around 61,500 odd crores. In this quarter itself, we have added around 16,000 crore worth of new orders. So certainly demand is strong. We not just see the demand from the local market alone. In fact, overseas market is also adding up a lot of orders in the current scenarios, including the orders coming in from US markets, order coming in from new markets that we have recently tapped in, like New Zealand, Australia, Europe, and Middle East. So there are a couple of markets which are warming up, and it just gives us a confidence that market is great enough for us to take a larger share in this.
So that's as far as revenue growth is concerned. Mr. Pari, good morning. Vishesha this side. And let's now talk about EBITDA margins, because they've moderated this quarter. What were the key reasons behind moderation in EBITDA margin, and is that reversible in the next few quarters?
If you look at our EBITDA margins in this quarter, it has been in the range of around 18.2%. And as you see that Vari has already lined up 10 gigawatt worth of solar cell capacity, which is one of the largest in this country, should go live in next 2 to 3 quarters of time. Our total cell capacity will go up to 15.4 gigawatt. That means our cell to module integration for the local market goes up from 20% current to around 65-70 odd percent, and balance of capacity keep reserved for overseas market. That means we will be fully integrated in terms of the module and cell capacities for Indian markets. And for overseas market, we are already having 4 to 1.6 gigawatt capacity in US, adding up another 1.6 gigawatt in US in this current quarter. So next 2 to 3 quarters, you will keep see the impact of new capacities of cell going live for Vari Energies in India, as well for new module lines going live in US starting this quarter.
All right, Mr. Parekh, Vari has also maintained its 7,000 to 7,700 crore EBITDA guidance for the full year FY27. Now, given the current geopolitical uncertainties, how confident are you still of achieving this target, and what risks do you see which may befall you?
If you see history of Vari, our guidance have always been met, or we have surpassed the guidance in past also. This year also we have given a guidance of 7,000 crore to 7,700 crores at the start of this year, and we have just reaffirmed our guidance post the Q1 results of this financial year. And we are very sure that we'll be hitting within our guided EBITDA. And this is not just on back of capacity. In fact, the new capacities of cell manufacturing, which is going live in next 6 to 9 months of time, 10 gigawatt, will ensure that Vari positions itself one of the company with stronger margin expansion scenarios given the new cell capacity in front of us. Apart from cell, we have 5.15 gigawatt worth of capacity of battery energy storage solution container, which got live a couple of days back. Apart from this, there are new capacities of like 1 gigawatt of electrolyzers, transformer capacity of additional 10,000 MVA. All of these put together, we'll see that over next few quarters, Vari keep seeing the support in the top line as well as in the bottom line in terms of the EBITDA margins and PAT margins.
Okay, and Mr. Parekh, a significant portion of your revenue is also coming from overseas market, and you've noted expansion across the US, Europe, and the Middle Eastern region. How do you assess the competitive landscape in your industry in the global markets?
Supply within the overseas market, exports from India plus domestic supply backed by more cell capacities coming in next few quarters, we're going to strengthen Vari's position to maintain our EBITDA and even expand on the margin front as well.
All right, Mr. Parekh, that's on the international markets. But tell us about this advanced BESS container manufacturing facility that you've recently commissioned in Gujarat. How does this strengthen your position in the rapidly growing energy storage market? And what role do you see battery storage playing in your future growth prospects?
When we talk about Vari 2.0, battery energy storage solution becomes one of the very important aspect of it. We are adding up overall 20 gigawatt hour worth of battery energy storage capacity, and we are not just talking about the equipment, which only lead to the some value addition. We are talking about the full scale integration from cell manufacturing, in-BESS, pack manufacturing, and then forward integration with container manufacturing. So this will ensure that Vari not just remain the leader in terms of capacity, but also continue to be the leader in terms of the vertical integration in BESS as well on lines of solar panels. Similarly, there are other opportunities which we see, like in India, government has mandated 2 hours worth of storage for all the ground mount projects. Recently, government has also indicated that the upcoming PM Surya Ghar Yojana also likely to include battery energy storage on the residential rooftop. And Vari has been the leader in residential markets and rooftop markets as well. If you compare our last quarter's numbers from the retail market itself, the numbers have gone more than 100% growth on a YOY basis. We have crossed 2,200 crore of revenue only from our retail arm in this quarter, which is a very, I would say, a positive growth in terms of the retail market itself.
Got that, Mr. Parekh. But you also acquired a 55% stake in Associated Power Structures. Now, should the market expect more such acquisitions like this coming in the near future?
Under Vari 2.0 program, we have been adding capacities organically. We have also been acquiring companies and adding capacities through M&A. We have last 1 year, we have completed more than 4 acquisitions already. And we have mentioned in our previous conversations also that Vari keep looking out for opportunities. But when we say opportunity, everything falls within the ambit of Vari 2.0 energy transition solution that we can add for our clients.
And Mr. Parekh, how confident are you of Vari's transformation into an integrated clean energy company and becoming Vari 2.0? And what message would you like to give your investors going ahead if they have to look forward to it?
I would say people should look at Vari's upcoming capacities and integration in India as well as overseas. This will ensure that Vari not just remain the largest non-Chinese company in terms of solar business in the world, which it has already achieved, but also continue to remain the most integrated non-Chinese company across the globe. When we say that our ingot and wafer capacity coming up in FY28, and we recently acquired some stake in Omani company, which is a polysilicon capacity, one of the largest polysilicon capacity outside of China. So that ensures that Vari remains one of the only company across the world which has got full stack integration in solar. Then we say that in BESS capacity, we are going 20 gigawatt from cell capacity to container and pack manufacturing. That also ensures that Vari becomes a full stack integrated player in energy storage also. Apart from this, we have started our transformer manufacturing. We are going to start our electrolyzer facility also very soon. Our inverter facility has already started giving great results for us. So all in one, Vari is looking forward to continue to be the most integrated energy transition platform for our customers, and we continue to serve them.
Okay, Mr. Parekh, all the best for the coming quarters, and thank you so much for taking your time out and joining us here on ET. Now, shifting focus then to Jammu and Kashmir Bank and the management is now joining us to discuss what the outlook is for the coming quarters. Remember, the company reported weak set of numbers for the quarter gone by, especially on the back of net interest margin expansion. But what's the outlook? Is the trend turning? That's the big question now. The MD and CEO of the company, Mr. Amitabh Chatterjee, is now joining us. Mr. Chatterjee, good morning. Shesha this side, and thank you for joining us today. And let's start by asking about net interest income, which was a big concern for the industry. The net interest margins have come under pressure this quarter. What were the biggest factors behind this compression, and how confident are you that margins will improve over the next few quarters?
Very good morning. Thank you for having me here. Obviously, when the margin shrinks this way, there's a concern for people, but I want to make it very clear. that this is an aberration for this quarter. The reasons behind, of course, are we all know that Jammu and Kashmir region went through a very bad phase last year, because of which the business was affected. So we saw the opportunities in rest of India business, mainly in good corporates. We took the opportunity, but as we all know that the deposits in the banking industry at the moment, the cost of deposits have gone high. So to support that advances growth and the growth momentum, we did not want to curb. So we continued with the growth momentum, but there was some high cost deposits which we had to take to support that growth. Obviously, those high cost deposits have been shed already. So going forward, the NIMs will definitely come back to the normal levels of 3.5 and above. That will be definitely in the coming quarters. We will see the improvement in the NIMs. But this is a one-time aberration that has happened because of good reasons. I would say the strategy was to continue with the business momentum without losing the momentum, and going forward, again, normalizing the things and focusing on retail growth going forward, as the bank essentially is a retail-focused bank.
All right, understood. Morning, Mr. Chatterjee. Meryl D'Souza here also joining in. I want to know, CASA ratios for the company has declined while term deposits have seemed to be grown. So how do you view the quality of your liability franchise today? And are there any steps? And if yes, then what steps are these that you're taking to rebuild the low-cost deposits going forward?
See, this is a normal trend in the banking industry, is it not? If you look at the reduction in CASA and the increase in term deposits in our case also, it is almost matching. So the deposits are moving from the CASA to high interest rate bearing deposits. That is a phenomena across the industry. It's not exclusive to our bank. But yes, we are fortunate to have a very strong liability franchising in Jammu and Kashmir. We have been working on this for the last 2-3 quarters, and we have been able to maintain the CASA levels above 42%. I must say that it is still 300 bips better than the average industry CASA. So this will continue, and the efforts that we are taking, they are showing results. I have seen the results coming in the last couple of months. So I'm very sure that we will be able to improve the CASA by at least 100 to 200 basis points going forward, if not within this year, in the coming 3-4 quarters. So I'm not, I'm quite confident about the CASA remaining or upward movement in CASA deposits. If you look at the in absolute terms, we have still grown in CASA. It's not a dip. But the percentage terms, it has dipped because term deposits have grown more.
Understood. So that's as far as the CASA ratio is concerned. But Mr. Chatterjee, let's also talk about provisions, because in the quarter gone by, there was a sharp increase in provisions in this quarter. What led to that, and how do we see this trend going forward during the year as well?
See, slippages have come down. NPA has come down. So obviously, this provision is something which is a positive signal for the bank. Yes, the increase in provision is essentially on account of standard assets provision. Standard assets in the last quarter, first quarter of last financial year, the advances had gone down. There was a negative growth. So there was a negative provision. There was a provision release on account of that. This for the last 1 year, we have had a very solid advances growth. So standard asset provisions have gone up by almost 60-70 crores. So if you look at NPA provision or provision on stressed assets, it has come down. But the provision has gone up in standard assets, which is a regulatory requirement.
Right, Mr. Chatterjee, that's that on your provisions. But tell us, with the transition to the expected credit loss framework now approaching, how well capitalized is the bank, and do you foresee the need for additional capital to support growth as well as regulatory requirements?
See, we are already set up for a capital raise very soon. So that is likely to happen in a couple of months. Other than that, I think we are well capitalized at the moment. The capital CRAR ratio is very comfortable for us. So yes, ECL is a concern for all banks. I mean, we are not an exception, but I believe that we will be sufficiently at a comfortable position when the ECL provisions have to be made. At the moment, I'm not in a position to give exact numbers because the model is yet not ready.
Okay, and when and where do you see the return on asset levels reviving upwards? So what will the key levers be for return on asset to inch higher?
It will come back to the 2026 levels very soon. I'm not predicting the date exactly. Maybe next quarter or the quarter next to that.
Got that, Mr. Chatterjee. And tell us, the bank has also been expanding its presence outside of Jammu and Kashmir. I want to know how important is the rest of India business to your long-term strategy, and what's your target mix between the J&K and outside of J&K?
See, there is something very specific about J&K. This geography goes through difficult times off and on, and that impacts the business. So it is essential for this bank to come out and increase its presence in the entire country. We are fortunate to be present in 22 states, and we are planning to increase that presence further, increase the overall business potential from the entire country. So from concentration risk point of view, from increased business potential point of view, it is very essential for us to expand in rest of India. And we are going ahead with that. In fact, in the next, say, 3 to 5 years, I think the ratio of branches, which is at the moment 85% in Jammu and Kashmir and 15% in rest of India, will definitely change to somewhere around 60-40 or 70-30 very soon.
Understood. So that's as far as the mix between Jammu and Kashmir and outside is concerned. Mr. Chatterjee, thank you so much for taking your time out and joining us here in ET Now and sharing your thoughts on where the company is headed going forward. Thank you for joining us today.
Thank you very much.
Shifting focus now to the market then, and let's take a look at what the market is doing. Nifty holding on absolutely flat at this point in time. 24,270 thereabouts is where the Nifty is now trading. Nifty Bank on the flip side is underperforming in today's trading session. Nearly 320 points shaved off on that counter, 56,890 thereabouts. Let's also take a look at how individual sectors are doing, and a whole host of sectors are in the green. And Nifty IT is at the top of that list yet again. Nifty IT should come up for you on your screens, 1.7% higher again. And several stocks from the IT index are doing well. Wipro, for instance, is up 3.5%. Persistent Systems up 3%. Coforge, Infosys, Tech Mahindra, LTI, Mindtree, all of them gaining in excess of 2% in today's trading session. On the losing side, though, we have the banking index is under pressure. Defense for the second consecutive day continues to remain in focus today. In fact, some stocks are under pressure as well. Astra Micro, that stock should come up for you on your screens, down 1.5%. Garden Reach Shipbuilders, Mishra Dhatu or Midhani, Zentech, Cochin Shipyard, all of them declining in trade today. Remember, we had seen some bit of pressure in yesterday's trading session as well within the defense basket, and that is continuing today. But that's all the time we have on this edition of the show. Thanks so much for tuning in. But don't go anywhere. More news and updates will continue on the other side. Stay tuned.